Hello and welcome to the latest video in our series of vlogs. This time we're going to be looking at things we need to think about when dealing with family investment companies. Firstly, we're going to be looking at what is a family investment company. And in truth, it's just a company. The only difference really is the way in which the shares are issued, with some being to the main proprietors, but crucially having a type of growth share which captures the future growth of the company being held by future generations or by a trust for the benefit of future generations. A lot is often said about, particularly when it comes to inheritance tax planning, why we don't use trusts. As part of a family investment company plan, we of course can and often do use trusts. But when we're comparing the use of a family investment company to that of a trust, very often the family investment company is a preferred structure because it enables those who are setting up the structure to also benefit from it during their lifetime. What I mean by this is when setting up a trust, once you've moved assets into a trust, you no longer have access to those assets. They are gone, they're outside of your estate after 7 years. However, during that period of time, you cannot benefit from them. When setting up a family investment company, you put the capital into the company, but as that capital grows and as you invest in other assets, those assets will generate income. If you're a member of family investments, if you have shares in a family investment company, you can take dividends out of that company, for example, to help support your income during your lifetime. And then once you do pass away, the assets move on to the future beneficiaries in an inheritance tax friendly way. As just touched upon, I suppose the main benefit of a family investment company is that you can benefit from it during your lifetime. Give you an example. You set up a new company, you put some money in and you use that company to purchase a property. That property gets let out and the income comes in. You might already be a higher rate taxpayer, so if you bought that property yourself, you would pay higher rates of tax on the income that it generated. However, within the family investment company, you would only be subject to corporation tax, which currently is 25% for investment companies, instead of potentially 40 or 45% tax. So an immediate annual tax saving. You can, of course, if you need to, draw income out of the company if you need it. Obviously, you will then pay income tax on that should you do so. But the main benefit of a family investment company really is the inheritance tax element of it. Yes, we're creating a structure here that you can benefit during your lifetime, but the idea really is that as the value in the company grows, it grows in a way that's not within your estate because the value of the shares that you hold are capped. The growth shares, which we touched upon earlier in this vlog, are the ones that hold the future value of the company. So as the company grows in value and you're able to, as I said, benefit from it during your lifetime, but when you do pass away, whatever the value of the company is, only the amount that you've capped your shares at is within your estate. The rest of that value would be outside of your estate because that value would be attributed to the growth shares held by your beneficiaries or a trust for the benefit of your beneficiaries. A couple of practical things that you need to think about when setting up a family investment company. As mentioned before, it is a company, so you are going to need to do company accounts, corporation tax returns, etc. and will most likely need an accountant to help you with those. If you're looking to move assets into the company that you already own, we just need to be a little bit careful about things like capital gains tax and stamp duty land tax, particularly if we're moving in property. When you move assets from your own personal ownership into a company that you own, you're essentially deemed to be selling it to the company at its market value. So using a house, for example, you might have bought a house for £100,000 in 1990. You want to move that property now into the family investment company, and let's just say it's worth 300,000. We've got a £200,000 gain there, which we're going to have to pay capital gains tax on. In addition, the company will pay stamp duty land tax on the acquisition of that property at the higher rates because companies always pay at the higher rates. Another practical thing to think about is when you put the cash or perhaps, as we've just discussed, the property into the company, it's effectively the company doesn't have any cash to give you, to pay any CGT liability, so we've got a bit of a cash flow issue there. But actually, quite interestingly, the company will owe you the money or the equity that you've transferred into the company, which you can draw back out during the family investment company's lifetime, tax-free. So let's just say instead of putting in a property, you've put in £100,000 of cash. Obviously, there's no issues with any taxes to pay by loaning that money in. But essentially, that £100,000 still belongs to you. And from an inheritance tax perspective, you haven't actually achieved anything, because you've swapped £100,000 of cash, which would be within your estate, for £100,000 IOU from the company. This is quite a nice thing that people who set up family investment companies quite like, is that often when setting up these types of structures, the idea is for the income to come into the company and for it to build within the company. But if, for example, it transpired that there was plenty of cash reserves in the company and you wanted to go on a fancy holiday to the Caribbean, you could just draw back on that loan owed to you by the company. Other things to think about when setting up a family investment company is how you're going to, or who's going to hold the shares. The majority of the time when we're dealing with these, it is often husband and wife looking to benefit their kids. So husband and wife might have A and B shares, which have the voting rights and rights to dividends, etc., and the capped capital rights. But then the C shares in this case, which would be the growth shares, can either be held directly by your children or your client's children, or it can be held by a trust for the benefit of current children, future grandchildren, etc. Obviously, it's entirely up to the client how they want to structure their family investment company. We often find that the trust element is the preferred one, just because it adds a little bit of extra protection against things like divorce or bankruptcy. If, for example, you had a child who was the direct owner of some shares that had a significant amount of value, well then, if they found themselves in financial difficulty and ended up in a bankruptcy situation, or indeed a divorce situation, then the value of their shares could form part of their pot, if you like, and would effectively be at risk. By putting a trust structure in, all we're effectively doing is removing that risk, because all they're doing is a right to receive income from a trust, which would be outside the scope of any bankruptcy or divorce situation. When it comes to inheritance tax, we've already sort of touched upon the key parts in relation to family investment companies and inheritance tax. When you create it in the first place, you don't really achieve anything in the short term. But the idea of a family investment company structure is it's a long-term, almost lifetime plan, with the idea that any money that you put into at the beginning is drawn back out and spent, or indeed it could be gifted to your beneficiaries. That would obviously be a potentially exempt transfer for inheritance tax, which, providing you survive for 7 years from the date of the gift, will mean that it's outside of your estate for inheritance tax purposes. But the primary focus is around the setting up of the shares, particularly the growth shares, in a way that captures the future growth of the company. As mentioned on day one, if you put £100,000 in, you've not achieved anything from an inheritance tax perspective because you're still owed £100,000. But let's just say that you, over the course of the next 20 or 30 years, you draw back down that £100,000, spend it during your retirement, and pass away with a company value of, say, £1 million. Whatever you've capped the value of your shares at, be that £100, £1,000 or £10,000, only that value will be within your estate, and therefore the other £900,000 in this example would be outside of your estate, saving tax at 40%. And that's it, folks. If you'd like any more information on family investment companies, do please send us an email to inquiries@etctax.co.uk, or head over to our website. There's lots of content on the website about family investment companies. But if you do have questions, do get in touch. We'd be delighted to help.